Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So I want you to imagine selling a piece of real estate, right? You sell a house for $100,000, you hand over the keys, and then you watch the buyer turn around and flip it to someone else for $500,000 that exact same afternoon.
Oh, man. Yeah, that would sting.
Right. You wouldn't be celebrating a successful sale. You'd realize you completely mispriced your house and, you just lost out on $400,000 you desperately needed.
Which is, a devastating realization for any seller. But if you take that missed opportunity and amplify it into the billions of dollars, and put it right in the middle of the most fiercely contested tech arms race in history, you have exactly what happened with the recent initial public offering of CXMT.
Yeah, let's get into that because according to recent data, CXMT, which is China's largest memory chip maker, they went public on the Shanghai Star Market on July 27, 2026. And the initial numbers, well, they look like a massive victory on paper.
Oh, absolutely. They're huge.
Right. They raised 57.92 billion yuan. In US dollars, that's about 8.6 billion. They priced their shares at 8.66 yuan, cementing it as the biggest Asian IPO of 2026. But the moment the opening bell rang, the stock price just absolutely exploded. It skyrocketed 466% to close at 49 yuan per share.
Yeah, a massive, massive jump.
But the financial press, notably analysts at Bloomberg, they didn't call it a win. They immediately labeled this massive price spike, a price discovery failure.
And, they labeled it a failure because of just the fundamental mechanics of how an IPO actually works. When a company issues shares to the public for the very first time, that initial sale price is the only time the company actually collects cash.
Okay, so that 8.66 yuan price.
Exactly. If an investor buys that share at 8.66 yuan and then flips it an hour later for 49 yuan, the investor pockets that massive profit. The company itself doesn't see a single cent of that 400+% markup. So CXMT essentially left billions of dollars on the table.
Which brings us back to the real estate analogy, right? If I leave money on the table selling a house, well, maybe I can't remodel my kitchen. But CXMT isn't remodeling a kitchen. They're trying to build semiconductor fabrication plants.
Yeah, and the capital requirements for those plants, they're often called fabs in the industry, are just almost incomprehensible. We're talking about structures that rank among the most expensive factories ever built by human beings.
Like, how expensive are we talking?
A single cutting-edge semiconductor fab can easily cost upwards of $20 billion.
$20 billion for one factory.
For one factory. And the specialized lithography machines inside them, those cost hundreds of millions of dollars each, and you need fleets of them. Plus, these machines consume massive amounts of electricity, they need incredibly specialized chemical supply chains, and, they demand round-the-clock operation by top-tier engineers.
So they need every penny they can get.
Exactly. The chip industry operates on a scale where $8.6 billion is basically just the price of admission. It's a down payment. So leaving an equivalent amount of capital just floating around in the secondary market rather than capturing it on your own balance sheet, that is a staggering strategic loss.
Okay, so if the capital requirement is that intense, pricing the shares at 8.66 yuan seems like, I don't know, gross negligence. You'd think their underwriters would have pushed the price higher to capture that cash.
Yeah.
But digging into the recent analysis or this deep dive, the data reveals a completely different, highly orchestrated motive.
Right. It wasn't a mistake.
No, this wasn't a miscalculation at all. Over half of the shares offered during this IPO were explicitly allocated to state-owned insurers and strategic government-linked investors before the public even had a chance to bid.
Yeah, and this is where we really have to separate traditional Wall Street logic from state-directed industrial policy. In a standard, capitalistic IPO in the U.S., the underwriter's fiduciary duty is to find the absolute maximum price the market is willing to bear.
Right, to get the most cash for the company.
Exactly, maximizing that cash runway. But CXMT's debut was clearly not designed strictly for corporate finance. By allocating over 50% of the shares to state institutions at a deeply discounted price, the government effectively engineered a massive wealth transfer.
A wealth transfer basically to themselves, right?
Precisely. The state-owned insurers, they get to mark those assets on their balance sheets at the closing price of 49 yuan. That instantly generates these astronomical paper profits that make their portfolios look incredibly strong.
Wow, okay.
And it also engineers a massive public relations victory. A stock jumping 466% on its first day creates this blinding halo effect, you know? It signals to the domestic population and to the whole world, really, that China possesses this highly valuable, unstoppable national champion in the semiconductor space.
Right. It builds an aura of invincibility. But wait, doesn't that aura fundamentally warp how investors measure risk? Like, if a state-owned entity is effectively acting as a backstop, hoarding the shares and guaranteeing the IPO's success, won't everyday investors start to suffer from moral hazard?
Oh, absolutely.
I mean, they'll stop reading the earnings reports, they'll ignore the technical gaps in CXMT's product line, and they'll just pile into the stock because they assume the government will never, ever allow it to fail.
You've hit on the most dangerous side effect of state intervention in capital markets. It completely severs the stock price from the actual business fundamentals. When investors believe a company is, quote-unquote, too strategic to fail, the traditional metrics of valuation, things like revenue growth, profit margins, intellectual property, they just get thrown out the window.
Because the safety net is the government.
Right. People stop investing in a business, and they start investing in a geopolitical policy.
Okay, so let's look exactly at how severed those fundamentals became. Because even at that supposedly discounted IPO price of 8.66 yuan, the data shows CXMT was trading at over 300 times its past earnings.
Yeah, which is huge.
Right. For anyone tracking normal equities, a healthy tech company might trade at 20, maybe 30 times earnings. 300 times is astronomical. And Morningstar's analysis actually calculated the company's fair value at roughly 16.2 yuan, specifically noting that CXMT lacks an economic moat.
And that Morningstar note is so critical here. In the semiconductor industry, an economic moat is usually forged through patents, proprietary manufacturing techniques, unmatched production yields, stuff like that.
Basically the secret sauce that keeps competitors away.
Exactly. It's the competitive advantage that prevents a rival from simply copying your product and undercutting your price. CXMT currently lacks that impenetrable defense. I mean, they are producing functional chips, certainly, but they are highly vulnerable to global price wars and technological leaps by their competitors.
So a fair value of 16 yuan reflects that vulnerability.
It does.
Well then, if the fair value is around 16 yuan, how did the market manage to push the price to 49 on day one, and then all the way to nearly 54 yuan by July 31st? The data points to a massive manipulation of market structure regarding the stock's float.
Yeah, the float is the mechanical engine driving this entire price explosion. So while CXMT has a certain number of total shares in existence, only 6.73% of those shares were actually floating.
Meaning they were legally allowed to be traded on the open market.
Right. The other 93.27% of the company was entirely locked up, held by those state VIPs, early investors, and insiders who were strictly barred from selling for a set period.
Okay, so it's the equivalent of a massive stadium, right? Say it holds 100,000 seats, but management decides to only sell 10 tickets at the box office.
That's a great way to look at it.
And demand for the concert is through the roof, so desperate fans bid the price of those 10 tickets up to astronomical scalper prices. But the illusion happens when you take that absurd scalper price, multiply it by all 100,000 seats in the empty stadium, and declare the entire building to be worth trillions of dollars.
Your stadium analogy works perfectly, but we need to add one more layer to it to capture the reality of CXMT. Imagine if the stadium's management wasn't just restricting the tickets, but actively utilizing that resulting hype to secure more funding and prestige.
Oh, wow. Okay.
That is the essence of the market cap illusion we are seeing here. Market capitalization is calculated simply by multiplying the current share price by the total number of outstanding shares. By squeezing the supply down to just 6.7%, a tiny fraction of retail buyers drove the price up to 54 yuan.
Which is just a squeeze.
Right. But multiplying that limit price by the billions of locked-up shares gave CXMT a staggering 3.3 trillion yuan market cap on paper.
But it's a phantom valuation.
Right.
It only exists because nobody's allowed to sell.
Exactly. It's a valuation built on artificial scarcity rather than actual economic output or technological dominance. And while a 3.3 trillion yuan market cap makes for incredible domestic headlines, it doesn't change the physical reality on the factory floor, nor does it alter the global balance of power in the semiconductor market.
Okay, so let's shift our focus to that global balance of power, because $8.6 billion sounds like a massive war chest in isolation. But just a few weeks prior to CXMT's debut on July 10th, South Korea's SK Hynix, one of the undisputed giants of memory manufacturing, they tapped the U.S. markets via NASDAQ ADR and raised $26.5 billion.
Yeah, an incredible amount of capital.
I mean, that is roughly 3 times what CXMT managed to pull together.
And the disparity in those capital raises, it really highlights the stark difference in technological capability. The money SK Hynix raised is largely earmarked for expanding their lid in high bandwidth memory, or HBM.
And HBM is not standard memory, right?
No, not at all. HBM involves physically stacking microscopic memory chips on top of one another and connecting them vertically. It is incredibly complex to manufacture, but it is the critical bottleneck for powering advanced artificial intelligence processors like the ones designed by NVIDIA. SK Hynix is completely dominating that high-margin, futuristic space.
Whereas the data shows CXMT holds about a 7.7% global market share as of 2025, and they are competing almost entirely in legacy chips.
Right, the older stuff.
Yeah, the standard DDR5 and LPDDR memory that goes into laptops, microwaves, everyday consumer electronics. So they are essentially bringing a knife to a gunfight against SK Hynix.
The capital gap is severe, for sure. But the technology gap is even more challenging because it's enforced by geopolitical boundaries. SK Hynix has unrestricted access to the deepest capital markets in the world, and more importantly, they have unrestricted access to the global semiconductor supply chain.
Which means they can buy the best equipment?
Exactly. They can purchase extreme ultraviolet lithography machines known as EUV, which are strictly manufactured by a single company in the Netherlands. EUV machines use light wavelength smaller than a virus to carve the impossibly small transistors required for AI chips.
And because of U.S. export controls, CXMT is legally barred from purchasing those exact EUV machines.
Correct. Without access to EUV, you hit a hard physical limit on how advanced your chips can become. You simply cannot print the microscopic features required for cutting-edge HBM using older, restricted equipment. So, CXMT is forced to fight an uphill battle.
They have to make do with what they have.
Right. They must pour their $8.6 billion into mastering older production methods, trying to squeeze every last drop of efficiency out of legacy machinery. They are not an immediate existential threat to SK Hynix's AI dominance.
But they are a massive threat to the bottom line of the broader industry, because the data shows that the moment CXMT's IPO numbers went public, global competitors like Samsung, Micron, and SK Hynix actually saw their stock prices dip.
Yes, they did.
And I'm guessing that's because if CXMT can't build AI chips, they are going to use that $8.6 billion to build massive factories dedicated entirely to everyday legacy memory chips.
And that triggers the classic commodity cycle panic. The semiconductor industry is notorious for these boom and bust cycles driven by supply and demand. Investors immediately recognize that CXMT is about to dramatically increase the global supply of standard DDR5 memory.
And when supply floods the market, the price of those chips plummets.
Which crushes the profit margins for companies like Samsung and Micron, who actually rely on the profits from those everyday chips to fund their own advanced research.
Oh, I see. So CXMT doesn't have to beat Samsung at the cutting edge of AI to cause severe financial damage.
Exactly. They just have to oversupply the legacy market enough to erode Samsung's foundational profits. It's a strategy of market share through sheer volume.
But volume brings visibility, and visibility invites geopolitical friction. The sheer scale of CXMT's $8.6 billion raise immediately triggered alarm bells in Washington. U.S. politicians began demanding national security probes into the company, citing concerns over potential military links and the implications of a heavily subsidized Chinese entity flooding the global market.
Yeah, it creates a fascinating geopolitical feedback loop. The U.S. government, currently under the Trump administration, operates with a highly hawkish stance on semiconductor supply chains. The success of this IPO basically paints a massive target on CXMT's back for even tighter export controls and stricter sanctions.
Which feels like a paradox, honestly, because tighter U.S. sanctions are meant to kneecap Chinese tech development. But those same sanctions are exactly what drives the Chinese government to heavily subsidize companies like CXMT, buy up their IPO shares, and lock down the domestic market for them.
It is the defining paradox of modern tech geopolitics. Every time the U.S. restricts a vital piece of technology, it inflicts acute short-term pain on companies like CXMT because they lose access to the best tools on Earth.
Right.
But simultaneously, it guarantees those companies a monopoly within China's massive domestic market, alongside unlimited political backing from Beijing. The sanctions create the very nationalism that funds the defiance of those sanctions.
Which brings us back to the reality of the business itself. The stock market can create 3.3 trillion yuan illusions, and politicians can debate sanctions. But ultimately, manufacturing silicon is a physical process. The real metric of success isn't the day one pop of the stock.
No, the only metric that truly matters is physical execution. Over the next 6 to 18 months, the global market isn't going to be watching CXMT's daily share price. They're going to be watching their capital expenditures.
They actually build.
Exactly. Can CXMT successfully break ground on new fabs? Can they install the equipment they are legally allowed to buy, calibrate it, and actually achieve high production yields on legacy chips without burning through their $8.6 billion in the process? Making a functional chip in a laboratory is science. Making millions of them profitably without defects is an entirely different discipline.
Okay, let's pull all these threads together for a quick recap of the data for our listeners. CXMT's IPO was a record-breaking financial event, bringing in $8.6 billion. However, the 466% day one spike represents a massive price discovery failure, meaning the company missed out on billions in crucial capital.
Yep.
And the sky-high valuation was essentially engineered through a tiny 6.7% float and heavy allocations to state-owned VIPs, which created a powerful market cap illusion.
And while their war chest is significant for the domestic market, it trails far behind the capital raised by global heavyweights like SK Hynix, who enjoy unrestricted access to the world's most advanced chip-making machinery. CXMT is locked into the legacy chip market by U.S. export controls, setting the stage for a potential oversupply that has global competitors bracing for impact.
It's basically a masterclass in how capital markets, industrial policy, and global geopolitics are constantly colliding. Before we let you go, what is one final thought our listeners should keep in mind as this specific financial puzzle continues to unfold?
Keep a close eye on the calendar, specifically on the expiration dates for those share lockup periods we talked about. We've established that this entire 3.3 trillion yuan valuation is being propped up by the artificial scarcity of a 6.7% float. Eventually, those lockup agreements will expire.
Oh, right.
Yeah, that tiny trickle of available shares will suddenly become 50 or even 100% of the company's total equity available on the open market. And when that dam breaks, we will see the true priorities of the state-owned insurers. Will they hold the line and refuse to sell, absorbing the market pressure to protect the stock price of their national champion? Or will human nature and fiduciary duty take over, prompting them to cash out their massive paper profits, sending the stock crashing back down to reality? It will be a real-time stress test between state loyalty and sheer capitalism.
A 3.3 trillion yuan game of chicken. It'll be fascinating to watch how the market handles that flood of supply. Thank you for helping us navigate the mechanics and the madness behind this massive IPO. Don't forget to subscribe and hit that like button.